Yeah, yeah.
Okay. Welcome back to Markets Today. I'm your host, Mbithe Mwema. If you asked joining us, it's certainly the first day of September. Very exciting day. Happy new month to you. What's the thing that we are learning today? We're understanding the tenets that if you're going to make an investment in any business, you better at least try and understand it. For this particular segment, we are joined by Linda Kiraithe. Linda is a senior analyst with AIBAXYS Investment Brokers, and she will be talking to us about the Tier 2 financials for the banking sector, as well as giving us the highlights for some of the non-bank financials that were released last week. A very warm welcome to you, Linda, and how are you doing? Can you hear me?
Thank you, Mbithe. Yes. I'm doing well today. So we can start off.
All right, a very warm welcome. So I'll just give you an overview of what we've been doing here. Yesterday, we were having a look at the Tier 1 banks. We had a deep dive looking at what was happening with KCB and Cooperative Bank. And we were trying to understand what was the key thing there. The themes that came through were non-performing loans, the loan loss coverage being the key thing that actually was driving down the profits for the season. Today, I wanted us to have an overview of some of the other banks that announced. That we have Absa Bank in there. We want to look at the likes of I&M Bank and, you know, the Tier 2 NCBA Bank as well, just to understand what's happening in that space. So before we look at the actual numbers, can you give us a sense of what is happening in the banking sector? One good thing, one bad thing.
Okay, I would say we have seen a surge in provisions, both for the Tier 1 and for the Tier 2 banks. So this has been one of the main, I would say, one of the main issues that has come up from their half-year earnings. However, this is as expected. This is what, as analysts, we had foreseen this coming, given that we expect that asset book will deteriorate given the closure of business, the general economic slowdown. So as NPLs have been coming up, you definitely expect to see that also the provisions will also surge, which was just as expected. And this has been negative on the bottom line, that is on the net earnings. And a positive for the banks is we have seen banks insist on that they are trying to really cut costs and control how much they spend on staff costs in terms of overtime, and they want to effect efficiency because they've also been working from home for some of the departments. So I would say the fact that they seem to want and to really take up cutting of costs would be a positive in such a time.
Okay, so I hear you saying that it's not a good time, but we have a very strong, network of banks. They are resilient and they have been able to weather the storm. All right, that's very good. Now
Sure.
let's dive in. Let's see. Absa, perhaps we can start there. So the numbers are down 85% for the year to about 0.6 billion. What happened with Absa?
Yeah. I would definitely, I would say just provisions. Absa has been one of the, I would say, the prudent banks in reporting. So they quite provided for their NPLs, and given the exposure to unsecured loans in the retail space, was expected. So it's not really a matter of because we saw stability in their interest income. It was flat year on year. We saw growth in their loan book and their deposits. So mainly what drove down the profit was provisions, which was just as expected. But I would say, given that their prudence in reporting, that's why we saw that the number was quite huge. They provided 3 times what has been the usual in the previous years. And that's why we saw their profit come up above 80%. So going forward, we might see this continue to persist. But I would say it's a positive thing, giving out the actual outlook of how the books actually look and how the numbers actually are for now.
Oh, fantastic.
Looking at the expenses, expenses remained flat, actually just under control year on year, apart from a one-off cost of 1.7 billion, which was related to their transition from Barclays to Absa.
Okay, so the costs were more or less in line, I think, tracking the... All right. All right, Linda, we lost you at the point of expenses were more or less in line.
So, say for ABSA for now, this despite the huge
Okay,
spike,
so there's...
really not much
Okay, so what's happening there with ABSA is...
Yeah, and especially the perspective that provision, yes?
Okay, so Linda, we lost you for a whole minute. Maybe we can take it off from the part that says ABSA, the expenses are more or less in line and they were expected. What was happening with the transition from Barclays to ABSA? Elaborate the one-off cost and whether this should be expected for the next reporting cycle.
Okay, we saw a one-off cost of about 1.7 billion, as I had stated earlier. And this is just part of the restructuring. We have seen the bank effect branding costs. There's also rationalization of processes, also on technology as they try to bring up alternative channels. So in terms of this cost, I think we should continue to see this in the short term. But I anticipate that going forward, maybe into 2021, we are going to see this cost come up because this cost was also in the books last year. So I believe that 2020, 2019 is when we are expected to see such huge numbers in costs. But going forward, we expect that this will come up.
Okay.
But for ABSA, I do not see it as a concern, given the fact that the parent company, that is ABSA Group, pledged to give off, that is to halt or to forego their dividend payment, so that this can be, the dividend that they're supposed to receive can be used to cater for the restructures. So this is not really, I would say it's not something much to worry about ABSA.
Okay, so the final question on ABSA, Linda, we have seen it come up with the top gainers list from yesterday. At about 9.3 to 9.5 shillings, is there an opportunity to buy and make a good return for the next 6 months on the NSE?
That's a good question. Right now, we have seen banks have been coming up slowly, and I believe that investors have seen that the low valuations are opportunities to really get in and take some pocket value, because we anticipate that the prices will continue to recover. We have seen markets have been recovering slowly by slowly. So I believe that this is also a good opportunity for investors to come in at the low valuations. So yes, I would say there's an opportunity, especially given the fact that we know that these banks are good dividend payers, and of course we remain hopeful that they'll pay a dividend despite the current rule on CBK on how they're going to control dividend payment.
Oh, fantastic. Thank you so much for that, Linda. So this ABSA's results were more or less in line with what is happening in the sector. Management chose to be extremely prudent, and at 9.33 there could be, or rather 9.3 shillings per share, there could be some possible upside, at least for the second half of the year. All right, Linda, maybe let's look at the NCBA numbers. What was happening with the NCBA group?
Okay, the bank also, the results were just in line with what was expected. We expected to see growth in NPLs and also increased provisions. So what was reported was just in line with expectation. However, for NCBA, something unique that stands out is that if you look at what NCBA's performance for this year, and if you add the operating costs for CBA Bank and for NIC for last year, actually the costs went down 1%. So this means that the bigger bank and the new entity is actually quite, I would say, efficient as compared to the operation of the standalone banks. Though we expected to see some costs because of restructures under the new entity, this has not been the case yet. But I believe that going forward, we might see some of these costs. And I believe that probably the restructures had been delayed by the presence of the pandemic.
Okay.
So this might change going forward as we continue to see recovery in the economy, and as we expect that restructures will take place quite soon. So for the new bank, of course, we continue to expect to see growth in unfunded income. CBA stood out as a top tier, I would say, digital bank. So the new entity NCBA is also expected to still stay in the same line, promoted by Fuliza and Mshwari.
Okay.
And so NCBA will be one of the banks to watch out in terms of an unfunded income growth.
Oh wow, fantastic. Another question, you know what it is? It hit a low of about 23 last week. It was the talk of the market. Should we be buying it at this level?
It's quite interesting given the fact that there's a bonus share in issue and the shares have not yet been allotted. So I would say the current low valuations offer a good entry point for the bank. There's so much value in NCBA as the new entity, as now a top tier, a tier 1 bank, the largest bank in Kenya. So I believe there's so much value for this bank, and the current valuation would be a good entry point, yes.
Interesting. So at least we're sort of seeing some spaces that we can play in this week. What about the other banks? We've seen Housing Finance, we've seen I&M Bank. Is there any other bank in the mid-tier, in the tier 2, tier 3 level that stands out for you in terms of there could be something interesting here?
I would say I&M has not been doing badly. Because just as in line with expectation, what has affected their books are the provisions, that is the impairments. For HF, honestly, I would say I don't see really so much value in HF. They have capital issues, they reported a loss, the operating expenses went down, yes, but I would say for now the bank has so much struggle, given that they want to come from a mortgage financier to a mainstream bank. I would say there's still a lot to do for HF, and especially the fact that they need about 1 billion capital injection means they would need to take up an additional loan, probably from a development bank to cater for this. So I believe that this HF really, I do not see so much value in it for now.
Okay, so then my final question, when we're looking at the banking sector, we also have seen the Central Bank of Kenya come out and say that for any bank to pay a dividend, they would need to get concurrence from the regulator. Does this have any impact on the dividend yield trajectory for the Kenyan banking stocks?
Yes, it does, because CBK wants to ensure that once the banks have incorporated the provisions and what they expect to provide for the rest of the year, and they are considering also their dividend payouts, CBK wants to ensure that banks are still able to stay well capitalized. So I would say this is just a precautionary stance, which is quite encouraged. And we have seen this even outside Kenya, where the Federal Reserve banks also put in such measures to say that they would cap dividend payments. So given that capital ratios are really quite something for banks, especially in a time where we have seen banks go down because of capital issues, I would say this is a welcome move. And of course, this is expected to affect dividend payments. So I believe that since CBK declared that the banks have, to pay out dividend, the banks have really to defend or give a good reason why they're paying dividends, then this means that we might see lower dividend payouts depending on how far the provisions are for the individual banks.
Okay.
So I would say for now, it's not really, we are not really certain how much the banks will be able to pay.
Okay. Thank you so much for that. We want to take a short break. When we come back, we'll be looking at the likes of Bamburi, NSC, NMG and Jubilee to get a sense of what is happening there. And now we just covered the first half of this conversation in terms of understanding the banks. We take a short break. Don't go anywhere. See you shortly.